Portions of KDKR programming do not necessarily reflect the views of this station, its management, or staff.
Prudent Money with Bob Brooks is sponsored by the Prudent Money Foundation on 91.3.
Well, with interest rates going up, how do you determine what is a good mortgage deal or not? Today we're going to take a look. Stay tuned for Prudent Money. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. Well, interest rates are on the increase and, of course, affecting mortgage rates. If you are looking for a mortgage, what steps do you take? Today, mortgage consultant and Prudent Money contributor Mark Pfeiffer is here to weigh in. Hey, Mark, how's it going?
Mr. Bob, I'm doing great. Thank you for asking. Thanks for having me.
So your world's a little upside down with interest rates going up like they are. I would imagine that every day is a new day, interesting day, as we watch all this. Let's talk a little bit about this. Interest rates, the 10-year interest rate was up again today, and I heard that the 30-year rate was back at 7% again. Is that
you heard correct?
I figured it had to be true. I didn't check it, but I got an alert, with how that goes. And so it makes things very interesting, and I'm glad that you're taking the time to have a conversation about this, because there's just a lot of moving pieces. It's not as if you just go get a mortgage. You really got to think through some things.
It's true. What's funny, Bob, and this is what I tell my folks is, I did not, and I don't know that many did. I don't know a single professional that I follow or subscription I subscribe to or just a coworker that thought rates would be at 7 starting March 1st. So as you know, rates were coming down. I mean, they got down to the low 6s and even high 5s there for a minute, and it all traces back to the job reports that the January job reports that came out early, first Friday of February, and it came out with this miraculous number that supposedly 500 to 800,000 jobs were created in the economy, and that's inflationary. And from that day forward, and then it's not so hot, inflation reading that came out about a week and a half later, and Bob, they just went up. So I just tell my folks, this is proof that I can't predict the future in the markets.
Well, hey,
I would not have guessed this.
You gave it a shot. I mean, it's just, I think that it's much easier to forecast when you don't have so much manipulation going on, and you just never know, because I think you and I have talked about this. I don't by any stretch believe that those employment numbers are real.
Couldn't agree more. And I think next week that'll be true. So what happens in January? They also the BLS, the Bureau of Labor and Statistics, they changed how they do their formula, the algorithm, and they hold the cards close to the vest, and we're not entirely sure what happened. But they also do an annual or seasonal adjustment. So if you take away and strip out all those artificial adjustments, supposedly there are close to 2.5 million jobs lost. Think about it, that's a $3 million household swing of jobs, and that's a big number. And I think that's what's going to come to fruition next week. To when the job reports comes out for February. Because if you look at Indeed, ZipRecruiter, all this stuff, there's a graph I saw. The job postings are down, way down. And so the reality is, I think, like you said, the manipulation piece, I just think next week we're going to see that, oh my goodness, the road's not so, or the skies aren't so bright and so shiny. And I think that is when we're going to see our rates start coming down again. But man, what a rough month. I do think, and this is right. When you say rates are going lower, eventually you're going to be right. What's that timeline? And so that's the part where I think the market does say, hey, we're going to see lower rates. When? I initially said I thought it'd be middle of this year. Foolishly, at the end of last year, I said, oh, maybe it's in the Q1. Okay, I'm back to Q2, Q3. So eventually we'll be right. But yeah, I think it has to do with just what are the real stats, what are the real facts, and then once we know those, the market can then adjust, and we'll see what happens.
Well, my favorite statistic about the unemployment number is that we, on one side of the equation, we added 517,000 jobs, which is a humongous add in any month. Then on the other side of the table, we've got all these companies week, day after day after day saying they're going to lay off people. So you look at, so you're a business owner, I'm a business owner. We look at it and we go, hey, things look real great in the economy. People are getting, looks like a lot of people are going to get laid off. I think I'll hire somebody. So I think I'll hire massive amounts of people and add to my costs because I'm so confident about everything that's going on. Makes no sense, but I'll get off that subject. So let's talk a little bit about. I'm just curious if you and I are in the process of securing a rate, going through the application process, and I've got concerns. What's your message to people that are in the process? Because I think that's got to be a tough situation. You know, if you started, let's say, a week and a half ago, and you're in the process, and what do you tell people?
Yeah, I think that's a big part too, right? The headlines a lot of times drive the market. It's unbelievable. January was a great month in terms of activity. Leads, everything was way up because rates were way down. Rates were now, like I said, low sixes, high fives. And so you got folks coming out saying, man, we've been waiting and we better buy. All of a sudden, February just got real quiet again. It's still busy, but not as busy. So now somebody's out there. I always tell folks, I said, look, at the end of the day, you know, the house is what you're buying for the long term. You know, the mortgage rate itself, you can get replaced if and when. So here's my argument. Hey, Mr. Smith or Mr. Homebuyer, do you think rates can eventually come down? Sure, I do. I think they can come down. Cool. Buy the house today. There are so many people that are sitting on the sidelines that now's the time to go out and you've got some room to negotiate. The sellers suddenly don't have as much traffic coming in the door. They're willing to do something. Maybe you can get that house for $5, $10, or $15,000 less than maybe you could have, would have in January. Or maybe if rates do come down in March, April, May, when school's starting to get out, you know, you could see those prices bounce right back. So maybe this could be the right time to buy and then refinance later on. Now, let's say they say no. Hey, Mr. Smith, Mr. Buyer, do you feel like rates are going to come back down? No, I don't. Cool. That means this is the lowest rate you're going to see. So either way, if you want to buy a house, go buy the house. But I always tell folks, follow the gut. I mean, yes, the payment's important. You got to be able to afford it. You got to feel comfortable with the payment. There's no question. But in a really, really weird way, this is a great time to buy. And so to answer your question, Bob, about how do we structure this or what do we talk about? If possible, and it's not always possible, but if we can, take the higher rate, try to not pay points, keep more money in your pocket from a cost standpoint, take a higher rate, grin and bear it, knowing that if and when rates do come down, spend the money at that time and go get the lower rate. Because the way the market behaves, Bob, I really do think sometime in the next 6 months, give or take, we'll see rates back in the mid-fives. That's my guess. We'll see if I'm right. But I think there's a number of reasons that say, 6 to 12 months from now, inflation is going to start coming down. We'll see real movement. I especially think in May, I think there's a big component of inflation. So if somebody's buying a house today, trust the gut. Buy the house. I understand the payment's not attractive because of the rate, but that's not a forever thing.
I think you do have to look at it as you talked about from the seller standpoint. That's a totally different way to view it. I mean, they're hanging on to higher prices, and I would think, as these interest rates nudge up, that's going to free some of these prices to where they come back down, which can offset the cost that you're incurring on the mortgage payment.
Yeah, again, if you pay an extra, let's just say $200-300 a month in mortgage payment. Not to say that that's what it is, but let's just pretend it's $200-300. I mean, that's real money, right? That's a car payment to some degree. So nobody likes that. But if you can get $10,000 off your house because now these sellers are motivated, they have a place to be, a job reload, something happens in their life, they need to want to sell this home. Well, if you get $10,000 off, paying $200 a month for 12 months is only $2,400 extra, and then you can refinance. So there is like I said, in a weird way, and I know it's skewed, and you can say, "Oh, it's a salesman, that's a glass half full." It may be, but it's still math. Like, it's still right. So if you can find that house and get the house that you loved and you saw and it feels really good, and you get a little more negotiating power and a little more leverage because the sellers see it. I mean, they got to go buy a home too. So that's the part where some folks are forced to sell because they have something going on in their lives. right? When some life event has happened and they're selling them. Now, there's others that are going to say, hey, we'll take that off the market, or we're not budging, or we'll wait for the spring season. But there are opportunities out there, no question.
So let's talk a little bit about this interest rate cycle. What's the highest rate that you've seen?
Man, so I've been, great question. I've been in the business, so I've been 2003, got in the mortgage business, and this is it. Like these low sevens, this is it.
But this is the high.
20,
this is
20 years.
This is higher than last year when it
was
up.
It's okay. It's right. It's comparable, right?
Is it comparable?
Last year it might have been 0.1, 0.2, higher, lower, whatever it is. But no, we're back to those high levels where we're in those low sevens, and those low sevens, by the way, might take points. You know what I don't like? Kind of go back to the manipulation piece, and I don't even want to call it manipulation versus just, call it data consistency. FreddieMac.com is what I've always quoted with you. Right? I always say go there because that's a good way to see it. Well, they changed their formula as well 2-3 months ago. So now they're going to show the rate. If you go at, I don't know what it is today, but it's like 6.5 or 6.6. And they no longer show the points associated with it. But if you go to like mortgagenewsdaily.com, they're showing rates at 7.1, which is more accurate. I mean, the 7.1 with a point is kind of where we're at today. So it's gotten expensive, certainly. So I do think, again, I think March and May, the jobs report in March, a inflation reading in May are going to be two really big catalysts to start driving rates back down. So I think those are kind of my big dates I got circled on the calendar.
One of the things I wanted to talk about today, and we talked a little bit about this last time, because I think this is information people need to know and understand who are in the process of perhaps selling or buying a house, is there. There's a lot of competition for these mortgage applications. Let's put it that way, and there's a lot of aggressive selling going on, and for those who are offering incentives, one comes to mind. There was two incentives. You probably know who I'm talking about, but they're big 1-800 nationalized company that I think that if you lock in today with us and you refinance in three years, we'll do it on less fees or something like that. I mean, tell me, how much of that is a real incentive to buy versus, to go through with the process with them?
Yeah, we won't name names, but you and I both have said it many times. They are a great marketing company that happens to do mortgages.
Yes.
Right? So great marketing, man. They are really good. And I'll be honest with you, it's almost like they come up with it, and then within a week, everybody's promoting it. It's the same, dog and pony show, so to speak. So here's what I'll say to that. Our company, we could do the air quotes here, free refi. We do. Honestly, we have it. I truly don't market it. You won't see it on my social media. You won't see it on our advertising. We're not pushing it to clients. Why? I just don't feel like that's totally transparent. The reality is, and you and I've talked about it before, there are third parties in every transaction. Title policy is the big one, right? The state determines that. I promise you our state is not giving away free title policies. There is real money involved. So the fine print can be one of many things. One will say, we as a lender will waive our fees. Well, that doesn't make it free. And then secondly, we all know, Bob, that it's hard to stay in business if you don't make a profit. So these companies aren't technically waiving their fees. They are, but it may be at the expense of a higher rate, which is something you can do all the time, every time, right? So it's not something that is like, we're just doing this free out of the goodness of our heart. The reality is it's just really good marketing. The idea and thought, which is a really good concept, is cool. If I do a mortgage with this person now and the rates are 7, I can come right back to this same person. So it's a way for them to get a phone call back and not lose the business to somebody else so that they can do the next loan. So is it free? Look, maybe there's a reduced cost because the company's willing to do it, but the reality is every mortgage company's willing to do it, and everybody wants that next loan, and they're just trying to build a little loyalty and some incentive to get that first phone call in the next go around. So it's great marketing. I commend them. I see the commercials. We copy them immediately. So it's really good. But I think everybody out there, if you hear the word free, there's always what's the catch? And I think everybody knows there's always that catch in the fine print.
Well, I think that the point that needs to be driven home is the fact that there's not a mortgage company that has an inside track to lower rates. They're all all of you guys are working off the same rate sheet, so to speak. And let's talk a little bit about points, because what you told me is, what you talked about at the beginning of the program is a little disturbing, that about the 1 point that's probably in the mix and not really disclosed. Talk about when you're talking about adding a point, what are you really saying to begin with? And kind of break that down.
Yeah, good question. So points, for those out there that don't know, let's take a $400,000 loan just for easy math. 1 point means 1% of that loan amount. So on a $400,000 loan, that's $4,000, $4,000. That's money paid at closing, right, by the consumer. So now when people say points, it could mean half a point. So half a point in this example would be $2,000. So what's interesting is since COVID, pre-COVID, Bob, I can't recall I've been in the business since 2003, so that's 20 years now. I can't recall an instance where points were like prevalent. There are instances here and there where somebody would do it and it makes sense, but overall, it just wasn't that big of a deal. COVID hit, market went nuts, people have uncertainty, nobody knows what's going on. All of a sudden, points have just become commonplace. Like, it's almost difficult to find a loan that doesn't have some form of points. I'm not saying there aren't any, but it's certainly swung the pendulum the other direction, where now points are being paid, and here's why. Mortgage companies, people are like, oh, they're getting rich. It takes, and I haven't seen the most recent stat, but the generic stat is it takes a mortgage company about the one I saw, 5.3 years to break even on doing the cost of the mortgage up front. They need to hold a mortgage and service it and collect the interest for 5 years to break even, which is nuts. So when you think about it, they need these mortgages to be held for a long time. But when people are refinancing 6, 12, 18, 24 months later, just because of COVID and rates go up, they come down, they go up, they come down, there's a huge cost. Now, while they're losing money on that loan, they're doing a new one to replace it. Again, goes back to that's why they're calling us. So the points, the reason why they're adding points now is if rates are at 7.x today, and you got a 7 in front of it, and rates do come down, let's say I'm right, let's say they go back even just to the low 6s. Anybody getting a loan today, within the next 12 months, there's a strong likelihood that they may be refinancing if they're closing today at the 7 to go get something at 6.5, 6, 5.5, whatever it may be in the future. So these points are a way to try to capture some revenue, at least up front, and kind of offset that risk and make it so that when these points are paid, and they're making it really enticing, Bob, too, to maybe pay 2 or 3 points. In the old days, you'd take 2 or 3 points, wouldn't do much. Now 2 or 3 points can buy your rate down a half a point to a full point. So something that makes the consumer say, man, I'll pay 2 or 3 points today. So the lenders get their revenue, but they also now have a lower risk of an early payoff, because now instead of a 7 rate, maybe the consumer gets a 6. A lot harder to refinance at 6 when rates go down to the low 6s, high 5s. So it is something that, again, I would just say talk to your mortgage professional, have an opinion, make sure they have an opinion on the market. Doesn't mean we have to be right. I'll raise my hand and say I've been wrong. But that strategy is going to be important to what you do today, because today's strategy is certainly different than it was 60 days ago. People in January, when rates were high 5, low 6s, is certainly a different strategy today when somebody's facing a 7 point something for a rate.
So let's take a hypothetical situation and say that you're going to do your mortgage with 2 points. You're going to pay 2 points. What would that theoretically? What would that bring your rate down to? I mean, not holding you to anything. Just
I get you. And I'm not. If I get a call from my compliance department, we'll be okay.
Won't be the first.
Yeah. In the old days, somebody paid a point. You might say, "Oh man, I'll improve my rate by a quarter." In today's world, it may be as much as a half a point. It could even end in rate. So 1 point paid today can improve your rate by half a point, maybe even 3/4. So you're suddenly thinking, "Oh man, you do the math, the break even for paying that." The old days, the point would take you about call it 3-4 years to see the benefit. Now, if you're getting that benefit in the first 2. You're like, man, it's worth it. I'll pay that money today, get a much lower rate, and so that's what the lenders want. And it's not bad practice. It's just they want that because hopefully, if they keep your loan a little longer, they make a little more money on the interest, and they can justify doing that. So it's a give and take. And I'm not saying one strategy is right or one strategy is wrong. It really is going to depend on the person, their timeline, their circumstances, the money they have in the bank, where they think the market's going. Some folks have appetite for risk and understand and trust and see what we see. Others don't, and that's fine. They're the ones making the mortgage payment. I think it's just the most important thing is to make sure you're having those conversations, have at least the facts, and then kind of use your own crystal ball to determine what strategy is going to be right for you.
This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. Mark Pfeiffer is here, as he is every month, to talk about mortgages. If you have any questions or you have want more information, go to mortgagemark.com. Let's talk a little bit about locking in. I could appreciate what an emotional process it is to go through this. I mean, you're all excited about buying a house, a new house, getting into it. You're grappling with this mortgage application. You're grappling with the interest rates. At what point do you say maybe you should lock this rate in? And I know that's a tough question.
Great. It really is, and that's the part we'll tell folks that, look, here's our 2 cents, here's our opinion. But in today's world, what's crummy about buying a home? Refinancing is different because you're already in it, and there's no moving ban and no contractual obligation to do something. But buying a home, when you think about it, pretty crummy. You only get like 1 week, give or take, to pick a rate, right? So it's based on when you find the home. Because if you don't find a home for 4 months that you love, okay, what are rates going to be in 4 months? Who knows, right? So it's kind of just a weird thing when you buy this. Your biggest financial purchase going to be subjected to whatever rates are at that time. So somebody looking around in December of this year is going to have a much bigger payment now in March than they would have 30, 60, 90 days ago. So as far as locking, the best thing we can tell folks is that, look, our crystal ball, it's never perfect. We can usually have a pretty good, handful of days, maybe a forecast. But if there's a big jobs report or something like that where we're just not sure, our advice is, look, if you like the payment, I shouldn't say like. If you can accept the payment,
yeah,
you're okay with it. Take it, lock it, because it's what if Mr. Smith, if rates went down 0.2, are you so much happier than if they went up 0.2? Which one hurts more? Which one feels better? Where's your risk tolerance? So for us, my big belief is you got about 2 or 3 days to figure out what you want to do. Lock it, move on, and just be in relationship with a lender that will be looking for your best interest to make sure it's structured correct today, and then be watching out for you so that down the road there's an opportunity where it financially benefits you, the consumer, the homeowner, to refinance, not do it just because the lender says so. Because that's what we've talked about before. In a refi environment, man, oh man, those call centers, they dial for dollars and they don't run the math, and it's just a different ball game for those type of lenders.
Real quick, Mark, said about 15, 20 seconds. What did the rates start out at this morning versus where they ended up?
Yeah, I think I would guess today about a quarter higher. It's hard to say because the market opened up before, the mortgage rates don't come out till 10-ish. So it's hard to say exactly. They call it about a quarter higher, maybe eighth a quarter higher in rate.
Mark, still keep doing the good fight, man. It's
Thank you, buddy.
It's going to be interesting. Once again, mortgagemark.com is where you go to get more information about Mark. Thanks so much, Mark, for coming on the program.
Thanks for having me, Bob.
This is Bob Brooks, and you are listening to the Prudent Money Radio Show. I tell you what, it pays to have somebody that you can talk to, that you can ask questions. You're going to get good answers, because the world of mortgages definitely can be confusing, and like I said, it's probably a much more stressful process today. Hey, this is Bob Brooks. You got a question for me, please go to the website at prudentmoney.com and send it in, because we are all out of time. Till we do meet again next time, keep the faith and have a great rest of the day.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.